in a runaway or straight up market, there's no stability. There's no foundation. There's no base. And that's why it could go down as quickly or usually quicker than it goes up. So I think I answered that sufficiently. I think we're going to be okay. I do see the end of the market like that, Elijah. It's almost inevitable because all markets get that blow off. If you look at the psychological aspect, there's a curve out there. I don't have it handy. But I looked at the stealth phase, the institutional phase, the smart money phase, and then it starts going parabolic, and that's the public phase. And then at the top, it says manic panic phase. And that's a pretty good illustration of the psychology behind markets. The fear of missing out that we hear about all the time. It happens to Bitcoin, it happens to real estate, it happens to tech stocks, and it will happen to silver. We're in a pretty frothy market right now. I mean, we've seen silver pretty much double this year, and we haven't had that kind of move in silver since the 1979 going into 1980 time frame. So that's one thing. Anyone that follows the metals markets is aware of that. I think the other part is have we gotten ahead of ourselves temporarily? Now, on an inflation-adjusted basis, the new 60 does not equal 50 of 1980 or 48.5 of 2011, but nonetheless, we are in nominal new highs. And I think we need a little bit of, let's say, of a pause, perhaps, kind of rebuild a base before this. I don't think it's a runaway market, but it's actually very, very strong. Several years ago, I was asked by Futures Magazine to write an article on silver. And it was a bit of an honor, really, because most of them have to be CMTs or whatever, certified market technicians. I'm not very well versed in technical analysis. But the title of the article Spiked. And then the subtitle is something about silver. But silver has a propensity to spike low and spike high. And of course, anyone that looks at that cup and handle that's been referred to ad nauseum in the silver community, which is true, it's a huge cup and handle, and it is the most powerful formation. But the point is that if you look at it, you see these big spikes, spike in 1980, spike in 2011, and now we are spiking again. And in the article, I pointed out that when you get a parabolic move like that, it goes more or less straight up, often referred to as the hockey stick. To reiterate what you just said, be careful what you wish for, because it is telling us.
Silver has a history of spectacular spikes, 1980, 2011, and now a new potential blow-off phase. Analysts often compare these moves to a hockey stick pattern, a near-vertical surge followed by an equally sudden correction. These parabolic rises don't signal weakness, but they do warn traders to stay cautious. When prices move too fast, the market loses structural support, making pullbacks more violent. Technical patterns like the classic cup and handle still point to long-term strength, yet history shows that nothing climbs straight to the sky. Even commodity giants like soybeans, oil, or copper behave similarly, sharp ascents matched by rapid reversals.
And it doesn't matter if it's silver, soybeans, soybean oil, whatever it is, a stock, it is going to correct very rapidly as well. And the end is nigh. Nothing can grow straight up and then not come down at some point. I think, to answer the question, that we will back off. We're backing off today as we're doing the interview. And I think we will build what's the most powerful formation to maintain a higher price, which is kind of a stair-step configuration. You go up, go sideways, maybe somewhat down a step or two, and then level off, and then back up, and then level off. And if you go up in that manner, you're building a base all the way up. So you have conviction on the buy side and the sell side, but you have conviction in the market. Whereas it just keeps going up and up. It's the last bid that makes the market. So what some people don't understand about a market, stocks, bonds, commodities, whatever, it's the last bid that shows up on the print at the end of the day. So let's, for a thought experiment, say that silver gets to $70 in the next week. And it's Friday and it's almost the close of the market and somebody bids 75. But it's for one lot, it's for one contract, and it gets accepted. Well, everyone that owns silver would look at that and say, my goodness, silver's at 75. Well, the paper price is at 75, and there's only one contract. One contract is not substantial. I mean, someone could come in and say, all right, I want to sell, and no one wants to buy it at 75. So the orders have to match. So the open orders at 71. And so that $4 difference gets gapped. In other words, the orders have to match. So there's a gap between the 75 and the 71. I hope I'm making sense here. But what I'm trying to point out is that
Sustainable bull markets are built on stair-step progress, rising phases, periods of consolidation, and renewed breakouts. This structure creates genuine conviction among buyers rather than fleeting excitement. Without these pauses, markets become vulnerable to massive air pockets, where a single trade can distort closing prices. For example, one contract filling at $75 could convince the world silver has hit that level, even if larger bids sit several dollars lower. In a stable market, these gaps narrow as liquidity spreads across price levels. Today's mild pullbacks may actually strengthen silver's trajectory, forming the base needed for future highs.
in a runaway or straight up market, there's no stability. There's no foundation. There's no base. And that's why it could go down as quickly or usually quicker than it goes up. So I think I answered that sufficiently. I think we're going to be okay. I do see the end of the market like that, Elijah. It's almost inevitable because all markets get that blow off. If you look at the psychological aspect, there's a curve out there. I don't have it handy. But look at the stealth phase, the institutional phase, the smart money phase, and it starts going parabolic, and that's the public phase. And then at the top, it says manic panic phase. And that's a pretty good illustration of the psychology behind markets. The fear of missing out that we hear about all the time. It happens to Bitcoin, it happens to real estate, it happens to tech stocks, and it will happen to silver. Well, the market has changed from being driven by basically the retail side. You know, the margin of the market is what is the investment or monetary demand for silver, and that ebbs and flows. And North America is by far the largest purchasers of retail silver products. And once silver got into like the 35 range, we basically had more sells than buys. So the wholesale market, and I know a fair amount of these people on a first name basis, and I check with them usually once a week or once every other week to see what their inventory is like. But in North America, we still have a lot. We have more sells than buys. So the retail side is kind of flush with product. But what's different this time, Elijah, is that the wholesale side, the commercial bar market, is short. There really isn't enough supply or barely enough supply to meet the demand that's coming out for both industrial purposes such as photovoltaics and ETPs, exchange traded products that are now come to the fore in India, which has caught on to the exchange traded products, and what's going on with the Shanghai Gold Exchange, where it's more of a physical market than either the LBMA or the COMEX. And there's a bigger turnover percentage-wise from what the paper contracts are versus the physical supply. And because of that, there's a high demand, and it continues. Now, whether or not it continues, indefinitely or not, remains to be determined. But basically, the last couple of months, as you mentioned, it looks as if that paradigm shift is, I don't know, but I think it's here to stay. I think you're going to see perhaps a new situation where the Eastern exchanges actually start to be more of a dominant force in the overall physical delivery mechanism than what we've seen in the past.
A major evolution is reshaping silver, the shift from retail-driven demand toward industrial consumption and wholesale shortages. North American retailers still have product, but large commercial bars, the backbone of industrial and institutional use, are increasingly scarce. Solar manufacturing, electronics, and new ETF demand in India have all tightened supply. Meanwhile, the Shanghai Gold Exchange has become a more influential center of physical settlement than Western paper-based markets. This growing Eastern footprint suggests a long-term rebalancing of global price discovery. If the trend continues, physical demand, not speculation, could soon dominate silver's future direction.
A few lessons with all the gray hair. And one thing I've learned is that over time, the premiums actually come back to normalize. So I actually just wrote an article, and I have it in front of me. I would read you part of it, but it's all about why the junk bag, or what I prefer to call constitutional silver, is really the place to look. First of all, that if you get that big a discount, why not take advantage of it? Secondly, the refiners are refusing it. Well, most of them, some will take it. That will go away at some point. And then lastly, the bag market does get a huge premium from time to time. And who's to say it won't happen again? I'm not going to forecast that it will. But if you look at Y2K, when, I know you know about that, you probably, whatever age you were. But, the rollover of 1999 to 2000, many people were worried that, there'd be a computer glitch. And many people bought bag silver because it's the most recognizable. It's small units. It's easy to use in a barter situation. And so it actually got like a 30 or 40% premium on the bag market rather than just, a silver 100-ounce bar or kilo bar. Now, again, I'm not saying that would happen again, but it could happen again. And also, I think it's a good place to start. I mean, the worst case scenario would be having the barter, but you don't have to look at it like, the banks are closed, I must barter. You can look at it more holistically, and what I do and have often done, and that's at a farmer's market. Local farmers, anything from, beef to flowers to all kinds of fruits and vegetables. And I take silver. Of course, I take fiat as well, but I'd say at least half of the people at the farmer's market.
Amid shifting market conditions, older forms of silver, junk silver or constitutional silver, are gaining renewed attention. Historically, premiums on these coins rise during periods of uncertainty, as seen during the Y2K scare when demand surged for practical, recognizable barter units. Today, many refiners avoid these coins because processing them is slower than remelting pure bars. However, when supply tightens, refiners eventually accept anything they can get. Meanwhile, constitutional silver remains a practical entry point for beginners, affordable, divisible, and highly recognizable. For many families, it has long served as the foundational starting point in a silver portfolio.
Will accept silver gladly, in fact, prefer it in some cases to using fiat, and that exchange takes place. So it doesn't have to be a end-of-the-world event to use, dimes, quarters, or halves in a transaction in those kind of locations. You're not going to get away with I should say get away with, but you're not going to be able to make a negotiation like that at Walmart or Safeway or, corporate entity. But on a one-to-one mom and pop kind of operation, you can. So I think still, and I've done this for years, when people ask, I'm just getting started. I don't want to make a mistake. Where do I buy first? And then I ask them, I don't really want their net worth, but I kind of ask them gently, well, what's your situation? And once I determine that, for almost all cases, I recommend start with a bag of constitutional silver for the family. So in today's parlance, that would be 1,000 ounces face value, dimes, quarters, halves could be mixed together. And that $1,000 face is 720 ounces, sorry. And 720 times 50 or 60, 7/6 is 42. So you're looking at maybe 40,000 in fiat. That's 10,000 per family member for a family of 4. And then I say, once you've established that, then I would move on to bars or coins or rounds. And the reason being is that bags are a bit cumbersome. If you've ever held a half bag or a full bag, like 70 pounds or something, it's quite 50-something pounds, sorry. Anyway, I still think that's a good thing. And regardless of today's discount, which again, you could take advantage of, if someone called me today and said, well, what would you do? That's exactly what I tell them today.
Premiums in the silver market always normalize over time, even after extreme shortages, such as the 2021-2022 American Silver Eagle premium spike. But structural pressure in 1,000-ounce commercial bars continues due to industrial growth, especially in photovoltaics and electric technologies. Refiners today prioritize .999 silver products because they can melt and pour them rapidly to meet wholesale demand. Processing 90% coins takes more time and cost, so they're pushed aside under current conditions. Yet if shortages worsen, refiners will inevitably return to remelting every form of silver available. In a tightening market, nothing stays ignored forever.
I will go back to what I said earlier. The premiums come back to normal over time. I mean, for example, one of my friends in the industry, you probably are aware of his name, perhaps you know him, but Franklin Sanders, he's my age or maybe a year or two older, not that that matters, but he's been in the industry a very long time. And he has a graph that I guess he does by hand that shows the premium in the silver market. And when we saw the very tight supply in Silver Eagles, where we were seeing, what, $14 premiums, something along those lines. And he was sending out his newsletter, which I get, to his clientele. Don't chase this market. The premiums always normalize over time, and they did. And so I'll just go back to that. I think even if we do get a spike and, game's over or whatever, I don't think you'd be unhappy having bagged silver. And then if the demand side continues, what we started our conversation with, where basically industry and institutional cannot get enough 1,000-ounce bars, those refiners will open up to whatever silver they can get to keep that supply intact, keep the demand filled. So I don't see that much risk to it. Pretty much I'll push back. I don't like that term push back, but let me elaborate. Right now, the reason that the refiners want 999, so silver maples, eagles, silver rounds, kilo bars, 10-ounce bars, 100-ounce bars, is because the refining process is almost automatic. You put all the stuff in a bucket, you heat it up, and you pour out a 1,000-ounce bar, and you do that all day long. Whereas if you do 90%, you got to re-refine it. You got to get rid of the copper, and you got to pour it again, and it's much more costly and time-consuming. So right now, they're trying to speed up the supply line as quickly as they can, which means all they got to do is melt and pour, melt and pour, melt and pour. And that's why they're not taking the constitutional silver, because the demand from the commercial side is so strong. They want to expedite it. The only way you expedite it is turn 100-ounce bars, 10 of them into a 1,000-ounce bar, rinse and repeat.